The last thing I was going to talk about is those intentionally defective grantor trusts that Harry talked about. In the past, we were concerned about making sure that we didn't fail the grantor trust rules because we wanted the assets to be taxed to somebody else or out of their estate. Now we're concerned in some respects to make sure that the grantor trusts are defective, meaning that the grantor, the person who puts the assets in the trust, is taxed on the income within that trust. And we did several of these last year. And so the reason they work is the fact that the trust and estate rules are different than the income tax rules. And so you're allowed to do certain things for trust and estate tax purposes that is completely different for the income tax rules. And so what you want to do is, so you set up a trust, right? So we set up this, let's say we set up this trust. And because of the trust provisions, we make it defective, meaning that it becomes a grantor trust, and the grantor is taxed on the income of the trust. And you do that by provisions in the trust, which basically give you too much power and control, and if you have power of control, it's as if you didn't give it away. And so what we've been seeing with, like, let's say somebody has an S corporation, and so you have an S corp, and you want to transfer some of the stock out of that S corp. And so you set up the trust, and it's a grantor trust. So that's the first step. The second step is that you can't, what we're going to do, the end game is we're going to actually sell the S corp stock to the trust. And so on an installment basis. So in order to do that, though, you have to fund the trust with something other than just the sale of the stock. So you have to put at least 10 to 20% of other assets that are actually gifted to the trust. So that could be cash, could be securities. So you put in assets of, let's say, 10 to 20% of the value. I've seen them with 20%, I guess, just to play it safe. Then we sell the S corp stock to the trust for an installment note. So it's an installment sale. Now, the grantor trust, all right, we're treated as the owner of the grantor trust. I own the S corporation. I'm selling stock to the grantor trust. I sell it there. Interest rates are low. The value of my company may be low because the last few years the economy's been down, so maybe, let's say, the valuation of my company is low. So I have a low valuation of the company. I have a low interest rate that I have to charge on that installment loan. And because I'm deemed to own the trust, I pay, for federal tax purposes, I pay no tax on the sale of the stock to the trust. And I pay no tax on the interest that the trust pays me when it starts to pay back the note. So I pay no federal tax on either the note payments, the installment sale, on none of the gain. And I do it for a period of years. And so the S corp makes, earns a profit. The profit goes into here. I may make distributions that go over to the trust. The trust makes its payment back to me. So let's say I have a 10-year note, and I'm entitled to get payments for 10 years plus interest. So the S corp profit, is reported over in the trust. I make this tax distributions to the trust. The trust pays me a certain amount of money each year. I don't pay any money on any of that gain. At the end of that term, and now the other thing is, I'm sorry, the income that the trust earns, because I own the trust and it's treated as if it's me, I also pay income on 100% of the S corp income. Let's say I own the company 100%. I sold 30% over here. 70% is going to come through the K1 to me personally. The other 30 is going to come through the trust, but it's also going to come to me personally. Now, if I pay for the taxes out of my own money, I'm also reducing my estate even further. So I am going to get some money back from the trust because I have to get my payment for 10 years. But if I'm paying all the taxes, and depending on the tax rates, I also get more money out of my estate. If I survive the term of the loan, all of the assets that are over here, including the appreciation of the S corp stock, everything in the trust goes to my beneficiary and completely escapes my estate. If I die within the term, what's included in my estate is the installment note. So it's actually a pretty good technique. It's obviously complicated. I actually wrote an article on it which goes into a lot more detail, which is in your packet. If you feel like sleeping at night, you can take a look and start. Make it through the first 2 columns. You might have to finish up the other 2 columns by the end of the next night. But it actually is a good, it's actually a good planning tool if you have an S Corp and you want to get it, or it can work with other assets too, but we've basically seen it with closely held stock, closely held S corporations. And it really works because the grantor trust for estate and gift tax purposes is considered to be still the individual for tax purposes, which allows your gain not to be taxed and gets all the future appreciation out to future beneficiaries. The only thing you got to be concerned about if you're an S corporation is that at some point, if you want to break that defective grantor trust, you got to be concerned who the beneficiaries are. The reason it works now with an S corp is because I'm considered to own the grantor trust. S corps have rules as to who can actually own the stock of an S corp. So you may have to make some other election, whether it be a qualified subchapter S trust or some election you might have to make at some point in the future.